The used car bubble. Following the improbable events that occurred in March 2020, the used car market took a wild turn. Everyone's favorite depreciating asset had suddenly become the opposite. Used car prices soared, and just as everyone assumed it was going to be a quick blimp, car prices just kept rising, making used automobiles almost as expensive as new ones. On February 1st, 2020, the average used Ford cost Americans around $22,000. Today, the average Ford will cost you $30,000. That's about a 40% increase in less than 3 years. A new reality had taken over the market. Used cars are in a massive super bubble, and rapidly changing conditions happening right now are pointing to the impossible. The evidence is now clear. The complete implosion of car prices is around the corner. The evidence suggesting this reality is considered overwhelming by many experts, and we begin with wholesale prices. You see, Manheim is a company that specializes in wholesale auctions. They're a massive player in the automotive industry with over 100 physical, digital, and mobile auctions. With so much insight into wholesale pricing, Manheim has a treasure chest of valuable and accurate price data that we can turn to see this implosion taking place in real time. Their used car index is the golden standard, and many analysts look to it for forecasting and analyzing the current market. It is essentially a measure of how much dealers are paying for cars, and right now prices are plunging. Since peaking in January of 2022, used wholesale prices have fallen over 14%, experiencing dramatic falls nearly every single month this year. And while yes, prices remain elevated compared to pre-2020 levels, the rapid change down is starting to break the market and introduce something called a deflationary spiral. You may look at this index and say, well yes, wholesale prices are starting to drop off a cliff, but as a consumer, I'm not seeing the price drops yet. And in this case, you are 100% correct. Right now, retail remains severely elevated and prices are close to flat, with some brands experiencing a small price drop. But as always, it takes time for retail prices to reflect wholesale prices. And once a consumer gets a whiff that deflation is happening, we know what happens next. It's a simple cycle. Consumers who are seeing prices drop in real time will become more incentivized to wait, as their dollars will be worth more as prices fall down. This is a self-feeding loop, as dealers who are waiting month after month to clear their inventories will be forced to lower prices even faster to match this massive drop in demand. This is called a deflationary spiral. Consumers have much less incentive to spend if they become aware that in the future they can get the same product for less. The same way prices skyrocketed as consumers realize costs are doing nothing but heading straight up is the same way they will come back down when they realize the opposite. And it's not just me saying it. Just weeks ago, CarMax reported earnings, and their leadership team was very clear about the future state of the market. Throughout the call, they go over all the things wrong with the market, how sales are declining, margins are tightening, and profits are lower, but ultimately, we get the clearest of evidence during the questions phase. And it happens when Brian Nagel asks the CEO this. So you're talking about the depreciation in wholesale. I mean, should that lead then to more attractive prices in the used car business and potentially undermine what has been a significant challenge for consumers? And that's the ultimate question we are after. Using the Manheim Index, we can see that wholesale prices are declining fast, but does that mean we're going to see retail prices follow? The answer he gives is quite shocking. Remember, this is a quarterly call, so most of the time leadership is trying to sugarcoat, but the CEO answers with this.
Yeah, I think you're thinking about it the right way, Brian. In fact, I believe this is probably the first quarter where the gap between used and new got a little bit wider, and gosh, probably 6 or 7 quarters. So it'll take some time, but I think depreciation and prices correcting on used will absolutely benefit the used market over time. But I think we got to keep in perspective. This quarter was challenging. I mean, we haven't seen $2,500 in depreciation. That rivals, in absolute dollars, that rivals back what we saw at the height of the Great Recession. That rivals what we saw at the peak of Omni. So it's a very unusual thing, and it brings challenges. But I think that we've proven over time that we've been able to navigate those, and that we'll do it better than pretty much anyone.
The CEO is making it clear this type of market turn hasn't been seen since the Great Recession, and if we turn back the pages of history, we can see just how shocking this period was for car dealers. The St. Louis Fed even wrote a paper examining the effects of this, labeled the 2008 U.S. auto market collapse, and what they found is that during the '08 recession, vehicle sales in the U.S. fell nearly 40%, causing significant job losses and unprecedented government interventions in the auto industry. The paper also looked at some explanations. One thing they point to is this long-run long-running survey by the University of Michigan, which essentially examines buying conditions for cars. Basically, what they publish is a car buying index based on consumer sentiment related to this specific market. And we have data going back to the early 60s regarding this topic. During the '08 recession, it was clear that sentiment was dipping, but it's nothing compared to what we're seeing today. The chart is at record lows, and given the history and reliability of using this graph to predict future prices, we should all be concerned. No period in history comes close to what we're seeing today. In summary, 3 important pieces of evidence point to a future collapse in used prices. One is the clear data we have coming from wholesalers. This includes the Manheim index, which year over year had its worst dip in history, suggesting that more pain is ahead and retail prices will follow. This is supported by the CEOs of the largest car dealers on the planet. For example, the CarMax CEO, who openly stated that what we're seeing today is almost worse than '08 in terms of depreciation. And then finally, we have the consumer sentiment data from the University of Michigan, which has been a reliable indicator of prices for nearly 50 years. And that chart is at record lows, suggesting that consumers are shying away from the market until prices stabilize and the greed is finally flushed out. As always, thank you guys for watching. Please make sure you hit that like and subscribe button if you enjoyed the video.